Welcome back. It's time for business, and for that I'm joined by Owen. Hello, Owen. So another tricky day ahead for Greece, but on the markets, so far, so good.
Yeah, investors have a pretty short memory, Claire, and going into these summits, they always seem to feel pretty good about them. All of the European markets open the day around 0.5% up or so. Remember, they brought this EU summit, this latest finance minister summit, forward a little bit, starting at around 3 p.m. Paris time. I don't know whether that's an anonymous sign that they know it's going to be another all-nighter and they're trying to just get a couple of hours extra ahead of another sleepless night. Well, we'll let our Brussels team worry about that one later this Monday. The Asian markets, though, as you say, Claire, a good finish by the Nikkei, closing the day just over 1% up. Some of the markets, particularly Hang Seng, just turning into reverse in the afternoon. There has been a lot of news flow out of Japan today concerning the trade deficit widening once again to record levels in January. Exports were down some 10%. That's a record high for Japan as it struggles and still struggles to pick itself up off the mat after the Fukushima disaster last year.
So EU finance ministers meeting in Brussels today to maybe, just maybe, sign off on that second Greek bailout. But you think that's only part of the story?
Well, it is, of course, that bailout, that 130 billion euros is vital for Greece. But remember, as part of that, investors have to be willing to accept massive write-offs in their investments. That's been part of the haggling for weeks now, partly what's held up this whole bailout. And remember, there have been noises for some time now, particularly this weekend, over what the Greek government might do in respect of those investors who maybe don't want to lose up to 70% of their investments, who don't want to take those haircuts. There's been more talk this weekend, more reports in Greece that the government will enforce what they call collective action clauses, where basically they will say to those holdout investors, too bad, we're going to enforce those losses upon you. And the legality of that isn't very clear right now. Could that mean a full-scale default? That, to many analysts, to many textbook analysts, would be the definition of a default, where those holdout investors simply say, well, this is a default, I'm cashing in my investment, Greece goes to the wall. There's also concern about the European Central Bank, which has been charging around 5% interest on its loans. Why should the ECB get that kind of interest when other investors are now being told to write off or take a lower interest for their investments? This whole issue about the legality of a bailout and, of course, the collective action clauses was something that we put a little earlier to the president of the Athens Chamber of Commerce, Konstantin Mikalos.
We're going to have a large percentage, approximately 70 to 75% haircut, and it will be with coercive measures. And I think that the activation of the so-called CACs, the collective action clauses, will eventually create a domino effect as far as the Eurobond market is concerned, because although it has been pointed out that Greece is a unique case as far as the haircut is concerned, we've already seen the reaction of the markets over the last 2 to 3 weeks towards Portugal in terms of both their CDSs and their spreads. They're almost at historical high levels.
That was Konstantin Mikalos from the Athens Chamber of Commerce talking to us a little earlier. And just to give you a few more numbers as well, remember this whole deal is aimed at bringing down the public debt levels of Greece to 120%, or so we thought under the terms of this deal. Now German officials tell us that it might be as high as 130% or thereabouts, maybe a little bit less by 2020. Those aren't the terms that many of these investors signed up to. And if they get some sense that Greece is going to miss those targets, then they might decide this whole deal is off the table. So there's still lots of work to be done on this. Of course, we'll see later this Monday whether those EU finance ministers are happy with the numbers that they've had.
Deal not quite sealed yet. Now, Greece isn't the only country steeped in austerity. Tens of thousands of people took to the streets across Spain on Sunday. It was the first major protest against the new government's labour reforms. Oliver Farry has more.
A huge turnout in Spain as unions fire the first shots across government bowls. It's the start of what is likely to be a long battle over planned labour reforms. Mariano Rajoy's Conservative government approved a bill Friday that will cut severance pay and make it easier to lay off workers. The government says it will help cut Spain's spiralling unemployment rate, but the unions say Rajoy is declaring war on workers' rights.
The immediate effects are many. First, it makes firing cheaper to an inconceivable degree. It puts an end to allowing any type of labour regulation. This is a strong attack, and we don't know what consequences it could have on labour relations in this country.
Many fear the reforms are a ploy to tap into a source of cheap labour.
They will fire the parents to hire their children for a quarter of the wage.
The government says the law will encourage short-term contracts and get more people into the workforce. But these protesters, already hit hard by successive rounds of austerity measures, are not convinced. The aim of protests, say unions, is to make the government reconsider the plan. They have ruled out a general strike for the time being.
OK, let's pick up on a couple more of the day's company headlines for you now. Foxconn's shares have dipped nearly 2% after the Taiwanese firm gave assembly line workers pay rises of up to 25%. The increases were given after Apple ordered an audit of working conditions at factories across China. Foxconn, which also builds gadgets on behalf of Microsoft, HP and Dell, has been under scrutiny since a spate of employee suicides linked to conditions at its factories.
And Rupert Murdoch is to launch a Sunday version of his UK Sun tabloid. The News Corp founder says the Sun on Sunday title will go on sale from the 26th of February. Last summer, Murdoch shut down the News of the World Sunday tabloid over its role in the UK phone hacking scandal. And oil prices in Asian trading have risen nearly 2%, taking US crude up to $105 a barrel. The surge in prices followed Iran's decision to cut oil supplies to France and the UK. But the impact is likely to be limited, as William Edwards explains.
Rather than wait for sanctions to come into place, Iran has decided to jump the gun when it comes to oil exports to Britain and France. The move shouldn't have a big effect on the two importers. France only got 3% of its oil from Iran last year, while Britain is thought to have stopped importing it already. As a whole, though, the EU buys around 20% of Iran's oil, with Greece, Italy and Spain being the biggest importers. The Islamic Republic is currently struggling to find new buyers for the spare capacity that will be freed up when EU sanctions come into place in July. Tehran will be hoping that China and India will cover the shortfall. But this uncertainty from the world's third largest oil producer has already meant a barrel of Brent crude is now trading at around a one-year high. Saudi Arabia has said it will pick up the slack and increase its supplies for European buyers, a move that has been criticised by Tehran. Nevertheless, European consumers will be concerned that prices at the pump are likely to rise, with the chief executive of Total saying it's only a matter of time before petrol prices in France hit €2 per litre.
And that's it for business. Thanks very much, Owen. That's it from me. Do stay tuned to France 24, all the latest headlines in just a few minutes with Chris Moore.